Welcome to the channel where we bring you the latest international news from around the world. Today, we'll dive into China's record $53.3 billion bond sale in the first quarter of 2024 and its significant implications for the U.S. economy. Let's take a look at how these sales could potentially change the economic landscape. China's bond sales are part of its strategy to diversify its investments and reduce its reliance on U.S. assets. These sales include U.S. Treasuries and agency bonds, which could have ripple effects throughout the U.S. economy. First, China's sale of these bonds could cause long-term interest rates to rise. When China gets rid of its bond investments, the supply of these securities in the market increases, potentially causing their prices and yields to rise. Experts estimate that a 30 basis point rise in 10-year Treasury bond yields will be challenging but ultimately manageable in the short term. However, higher U.S. rates compared to low European rates may attract private funds into the U.S. debt capital market. Second, China's bond sales could affect the value of the U.S. dollar. As China sells its investments in U.S. dollars, we may see a depreciation of the dollar against other major currencies. This scenario has a dual effect on the U.S. economy. On the one hand, a weaker dollar could boost U.S. exports by making its products cheaper for foreign buyers, potentially stimulating economic growth. On the other hand, a weaker dollar could increase the cost of imports, leading to higher inflation and negatively impacting consumer spending and economic growth. Third, these sales could affect the Federal Reserve's monetary policy decisions. If China's bond sales lead to an increase in the value of the U.S. dollar and growth in the U.S. economy, the Fed could slow the pace of interest rate hikes or reduce its quantitative tightening or balance sheet reduction program. This could have significant implications for the overall direction of the U.S. economy, as the Fed's actions have a profound impact on interest rates, inflation, and economic growth. Therefore, any change in their approach due to China's bond sale is critical to monitor. Finally, China's bond sales could affect the U.S. government's ability to finance its debt. As China reduces its investments, demand for U.S. Treasuries could decrease, making it more difficult for the U.S. government to finance its debt. This could lead to higher interest rates and higher debt service costs for the U.S. government, with long-term implications for the U.S. economy. To summarize, China's record bond sales have significant implications for the U.S. economy. While the exact impact is difficult to predict, we can expect the Chinese government's bond sales to have a major impact on long-term U.S. interest rates, the value of the U.S. dollar, the Federal Reserve's monetary policy decisions, and the U.S. government's ability to finance its debt. Thank you for watching Ultima News. Don't forget to like, share this video, and subscribe to our channel to receive in-depth analysis and the latest news from around the world. Have a great day.